welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 152. On today's episode, we got a lot to get to. There's been a lot of market changes over the past couple weeks. We have a new president-elect. We have earnings season that's come out. We have the stock market just on an absolute tear. And so we need to just have a quick conversation about everything that's going on, some of the company earnings that have come on, and just kind of take a step back, reevaluate the market, and kind of figure out our plan from here. So get your mind right and let's get to work. Well, welcome back to the podcast, everyone. Appreciate you joining me once again. And I know everybody, well, most people are excited about the Guy Spear episode. And so I will be working on that this week. It's going to take me a little bit to, they loaded it. They got video. We got all kinds of stuff. So it's going to be a little bit longer to get that one ready to go for your ears. But I will work on that. We'll probably release it as a two-part deal at the same time, but kind of break that episode up, at least on the audio, and then we'll release the full video on YouTube. So pretty interesting. That is, if I interviewed Guy Spear a couple days ago, and it was really odd. I think you'll be able, if you've listened to this podcast for a while, you'll be able to tell in the beginning, it was really surreal. Somebody you've thought about meeting, somebody you've read about them, followed them for a number of years, and then to be looking across a table and they're sitting right there in front of you. It caught me off guard for a little bit. And in the beginning, I was a little nervous, and then I think I finally got my feet under me. But it was just, that was one of the things I wasn't expecting. It wasn't like I don't know. It was just the fact that, it's one of those, a goal that you set for yourself, and then all of a sudden it's here, and then you're trying to soak it in at the same time that you're also trying to be present and interview somebody. That was a little bit of a challenge, but I wanted to record an episode before releasing that one just because so much has happened in the market. And these aren't things that he and I discussed. And so I wanted to, before too much time passed, I wanted to record an episode just kind of with my thoughts about the election, how the stock market has performed. And so when you look at the presidential election, all the stuff I recorded before it is already wrong, because I said, we probably wouldn't know who was going to be president the day after. I was completely wrong on that, right? So now we have President-elect Donald Trump. So a second Trump presidency, first president since Grover Cleveland to serve non-consecutive terms. So gets in the record book with that one. And so we look and we see how the market has performed, and the market has performed extremely well since he was elected. So the day after he was elected, the Dow Jones was up 1,500 points, which percentage-wise is the greatest. It's the greatest post-election day for the stock market ever. And so the market as a whole just had a tremendous week after the election. So we're sitting here at currently, this is on November 10th, with the Dow Jones up 16.7% for the year. We have the NASDAQ up 28.5% for the year. And we have the S&P 500 up almost 26% for the year, which, letting you know right now, these are tremendous gains for the fourth year of a presidency for somebody. Normally, election years are not near this good. When I wrote my client letter last year, it's one of the things I discussed is how volatile election years typically are. So we are kind of sitting here in the sweet spot as far as market performance is concerned. The last 2 years have been just incredible. We also had the Federal Reserve on Thursday lower interest rates by 25 basis points again. And so interest rates are coming down. The economy's still doing well. And so, what could go wrong? And so, for me, when everything is going right, I'm not saying I get a little nervous, but I start to get a little nervous, so how much, this is typically the best season for the stock market. So when you go from after October through the end of the year, right, we get what we call this Santa Claus rally. I mean, the Santa Claus rally by definition is much shorter, but you know what I mean? Like the holidays, the market's usually doing pretty well in November and December. And so if we really like blaze a trail to the end of the year, I'm going to be looking to book some profits. And so the reason for that is that right now I feel like there's a lot of euphoria with Trump winning the presidential election. We know that there's going to be some changes. If you just go look at some of the best performers, and these are, some that we've talked about on the podcast already, companies like Goldman Sachs, companies like Morgan Stanley. Those are some that we talked about investing in over the past couple years because there wasn't any mergers and acquisition activity happening. And that's where Morgan Stanley and Goldman Sachs really make a lot of their money. And so they were paying a great dividend. Morgan Stanley, I know when it was at about $82 a share, was paying a dividend of about 3.6%. Well, now Morgan Stanley's trading very close to $130 a share. And its dividend yield has now dropped to 2.86 or so, which is still pretty good, but not near as good as it was at 82. And so with the Trump presidency, we start thinking about, so what's going to change with the market? Well, Trump is much more likely to reduce regulation, and so, or government interference, or whatever you want to call it, but he's much more likely to be favorable towards companies, the market. And so you see this being priced into Morgan Stanley and Goldman Sachs because there has been so few mergers and acquisition deals, and they've blocked pretty much everything that's come down, that you should see a pretty good influx of IPOs. So IPOs, initial public offerings, companies coming to the market for the first time. And then you should also see some deals that, had been blocked that might be back on the table. So one of those could be Spirit Airlines and Frontier Airlines. I mean, Spirit, their symbol is SAVE, S-A-V-E. They have gone this year from, $15.88 to $2.70. So definitely hasn't been a good year for them. But if they're able to possibly work on that deal, merge with Frontier Airlines, you could see some activity happening there. So there's going to be those kind of opportunities that probably haven't been around under the Biden administration. And so really, as portfolio managers, as you look at your portfolio, it's like, okay, how do I shift my portfolio? How do I lean into certain areas? I mean, obviously, it's been a pretty fantastic week for Elon Musk and Tesla. Tesla hit $1 trillion again this past week, and Elon Musk's net worth is now above $300 billion. So I think he spent, $130 million helping Trump campaign, and he definitely got that back with a pretty good sizable increase this past year. But a lot of the companies that we've discussed on this show, NVIDIA, all the Mag 7s, Palantir doing amazing. The only one that did not do well this week is Mercado Libre. Smelly Melly this past week. But Melly beat on sales. They beat their revenue number, and they missed on their earnings. Their credit card division, they're pumping a ton of money into that. So they dropped $300 a share, I know. So $2,100, they were $2,100 a share. They dropped to $1,777, and they finished the week at $1,872. I think that's a little bit of an overreaction for them. I do think that'll come back. Melly, I know a $2,000 stock is not one that everybody can invest in. I wish they would split that stock to make it more accessible to everybody. I really wish they would do that. So there's still going to be some opportunities in the market. Obviously, there's always opportunities in the market, but it's a give and take. I mean, there's some times where it's, you're much more, the risk reward is there when, things have been beaten up, things are at, lows. The there's certain times in the market where the risk reward is a better setup than others. And that is true a lot of times. And so when you look at the gains we've had over the last couple of years, 2023 was great. Sorry, 2022 was horrible. Absolutely horrible, like all-time horrible, especially if you're in the bond market. 2023 was a great recovery year. 2024 has been a great year. Even with the economy doing well, I mean, how many great years can we have? And so I'm not saying you sell out. I'm not saying anything like that. Remember, I'm not your financial advisor. Entertainment purposes only. Talk to your financial advisor. But if we keep having gains like we've had, the risk reward is not going to be in our favor that much. The Shiller PE ratio that was developed by Robert Shiller, the Yale professor, I'm looking at that, and the highest it's ever been. So PE ratio standing for price over earnings. So price to earnings index, which is the price of a stock divided by the earnings level, gives you the PE ratio. And so as that gets higher, that means that the stock price is getting basically away from the earnings, and there's really the earnings don't support the price anymore. And so as that price goes up on the PE ratio, it's like how many more investors can be there. And there's a pretty good amount of money off on the sidelines. A lot of that came into the market this week with Trump winning. And so back to the original thesis here, the highest PE ratio that we've ever had as a market. So this is the PE ratio for the S&P 500 for the market in general. The highest it's ever been is 44. That was in December of 1999. And so the second highest it's ever been was October of 2021, which is 38.58. And right now we're at 38.52. So we might go above where we were in October of 2021. We still have earnings coming in, all of that kind of good stuff. But I'm saying that there's a lot of euphoria. There's a lot of hope in the market. There's a lot of, Trump's going to change things, which I know he will. But does that get priced in before he's even president? And I say that because we've already, different circumstances for all of us. None of us were alive, unless you're a vampire. None of us were alive when Grover Cleveland served non-consecutive appointments as president. So the market looks at Trump's first presidency. He sees all the things that he did, and it kind of mirrors it now, thinking about how the market's going to do based on if he does all the same policies. Now, there's no guarantee that he's going to do that. He's talked about, all the tax cuts he's discussed, all the tariffs he's discussed. And so my concern is that if he does those things, and again, I don't think he's going to do everything that he talked about. I don't. But some of those things, if you lower taxes for everybody, if you do those things, that incentivizes people to go into the market to spend that money. And so that is kind of an inflationary policy, right? So if people do those things, we could have inflation again. And so you got to be very careful this time, because he's not going into an economy that has a 2% inflation rate like he did the first time. So not everything is the same setup as it was when he became president. So, the same policies aren't going to have the same impact as they did back then. And so my whole point to this whole ramble that I'm doing is that, it's like Warren Buffett says, right? When everybody's being greedy, be fearful when others are greedy, be greedy when others are fearful. And so I look at, okay, how much euphoria is going to be in the market? How much of Trump's changes are priced in before he even becomes president? And so I'm going to talk a lot about over the next couple of weeks as we go into January 20th when he does become president. How does the market look between how has the market performed from election day to inauguration day? I mean, that's really what I'm going to want to see, because, if a lot of this has been priced in, man, the risk reward isn't going to be there. And I'm not saying, you sell out, but like we talk about on this show, there's some times where you take profit, you trim a little bit, you build up your cash reserves, because, Trump is known for being a little erratic. He says something, stocks move. I mean, you're going to have some cash on the sidelines to be able to take advantage of that when the market overreacts to things that he says or does. And it turns out that it was just something he said and it never actually got, enacted. So those are the kind of things that you have to think about, and you have to think differently when everybody else is celebrating and, the market's kind of going crazy because of what the expectations are going to be versus how does it actually look in reality. And so if he's able to lower corporate taxes, which he has also discussed, we'll see how the market reacts to that. But also, we're going to have to pay attention to how the bond market reacts, because the deficit for the U.S. is much higher than it was when Trump took office. And so at some point, the bond market is going to react to the level of debt that we have. By the time Trump takes over, our deficit could be at 106% of GDP. So at some point, the bond market is going to say, we're no longer going to buy the debt at this level. You're going to have to give us a higher interest rate to buy this debt. And all of a sudden, you're going to see the long end of the bond curve, which is going to be 20-year bonds, 30-year bonds, where all of a sudden they're going to require a higher rate and inflation starts to come because the bond market starts kicking it back. So there's a recent interview by Paul Tudor Jones on CNBC where he talks about the U.S. debt, and he does it. Paul Tudor Jones, incredible investor, called the 1987 crash, but he does a great job in making it to where you understand how much debt the U.S. has. And his analogy was the fact that, he says, okay, let's say you make $100,000 a year and you've already borrowed $700,000. And you go to the person that you've borrowed $700,000 from and you say, hey, I know I've already borrowed a lot of money from you, but I need to borrow another $40,000 a year from you over the next 30 years. And then at the end of that 30 years, I'm going to pay it all back to you. Would you make a loan to that person who's already borrowed $700,000 from you, makes $100,000, and now they need $40,000 extra every single year for the next 30 years, and they say, we're just going to pay you a big lump sum at the end of that? You probably wouldn't make that loan, and that is currently the state that the United States is in. That's how much money we have borrowed, and we're not alone. All the other countries in the world, there's a huge, huge debt from all the countries around the world, and so we'll see how this plays out, but it is something that is a concern. And so you look at somebody like Warren Buffett, who has raised his cash pile to above $325 billion of cash, which when you look at Berkshire Hathaway's value, that puts his cash at about 32% of the entire portfolio. And you'll hear Guy Spear and I discuss that a little bit on our interview. And it's like, what is he thinking? I mean, obviously he's 94 years old. But man, that's a huge cash pile waiting to see what happens. And so it's a little bit of, I would say, cautious optimism, but looking for opportunities to maybe trim a little bit, raise your cash pile, because if things don't look so good right after, if the expectation is that Trump's going to make all these amazing changes right away and it doesn't happen, then you'll probably have the opportunity to get some pretty good investments in February or March, right after companies report at the end of January for that fourth quarter. So we say that, but also the market can be irrational for a long period of time. And so you want to, sounds like I'm talking out two sides of my mouth here. And that's why portfolio management is so difficult, because it's hard to pull off a little bit when everybody's having such a good time. So you got to find that right balance. For me, I think about 2022, haunted by 2022, what a difficult year that was for me. And so I'm constantly thinking about how do I try to make sure that not that it doesn't happen again, but that I handle a little bit better and maybe take more profits before something like that happens. So those are my thoughts. And you're going to get a lot more of them if you continue to listen between now and the end of the year and the election. So I hope this was helpful for you, makes you think about things a little bit differently. not to dampen the party, but to just think about, okay, what are the expectations going to be if we pull a lot of those gains forward before Trump actually goes into office? What is it going to look like next year? So I'll get that Guy Spirit interview out as soon as possible. As always, don't mistake activity for achievement, and I'll see you next time. Thanks, everybody.